Okay, everybody, today we're going to talk about Black Tuesday, the stock market crash as it's known. One of the worst days, actually the worst day in the history of the stock market. We saw recently a big decline in 2008, but even still, Black Tuesday marked a very different era when it. Uh, Before we get into that, in 1928 we have an election. Herbert Hoover is running as a Republican. He had been Secretary of the Treasury. Hoover was a very hardworking individual. We'll talk about why he's considered a bad president, but he does a lot of things for the United States, both before and after he was president. He ran against a guy named Alfred Smith. I talked to you about him earlier in the year. He's the first Catholic to run for president, and that's why they have that Alfred Smith dinner that during the election you saw Hillary and Donald Trump. They were exchanging very light jabs at each other and what was supposed to be a good-humored type of situation. The 1920s, like we talked about, showed a lot of prosperity. There was, large gains economically for many people. It's the Roaring Twenties. There's a lot of really good things happening, both economically, socially, and as a result of that, Hoover wins easily. It's, the 8 years have been good, and keeping with the Republican Party was something that the United States and its people decided they were going to do. But very shortly after, just months after Hoover is inaugurated, we see, the beginnings of the worst economic history. So what led to this? What brought on this great crash in the stock market? Well, one of those things was credit. And credit had become something that people were using more than ever. They were using it to buy automobiles. They were using it to buy appliances. We do this today, but people spread themselves very thin, extended their credit, and they were not saving a lot of money. They just kept getting loans and things of that nature, and that's never a good thing. So the buy now and pay later philosophy really takes hold, and there were a lot of people not ready for that. There weren't all the people warning of the dangers of doing that and how to be responsible with that. So, credit was an issue, but the bigger problem is how easily it's available. Banks can loan out a lot of money, but if they loan it to everybody that's going to pay it back, then that's great. But when they start lending it out to too many people where they are not exactly the best people to lend money to, and the banks don't get their money back, this is where we get a lot of problems. So paying off large debts towards the end of the 1920s becomes much more difficult. Wages weren't exactly keeping very fast pace later on in the decade, so that created people had a lot more trouble paying a lot of their debts. Now the market during the 1920s were seen as the quickest way to prosperity. There was a lot of get-rich-quick stuff going on. And throughout the 1920s, stocks rise very steadily and sharply in some cases. And people see others making a lot of money in the stock market. And naturally, when others see people making money and it appears to be very easy, they want to do it too. But what's always true is, easy money is not always what it seems to be. The market hits a high of 381 points in 1929. This was 300 points higher than it was just 5 years ago, so 5 years before that. So this is a drastic increase in the stock market. And typically with economics, anytime something rises that fast, there better be a really good reason for it, or the more likely issue is that it's going to come crashing down the line. Now, that number is what's known as the Dow Jones Industrial Average. The Dow is something that people look as kind of an indicator of how the market's doing. It's the prices of 30 large firms trading on the New York Stock Exchange. And that average price between all of those, they figure out, and when that price goes up, the market's doing well. When that price goes down, typically the market's not doing well. It doesn't mean everyone loses. It doesn't mean everybody wins when the number goes up. But overall, it's a good sign when it goes up and a bad sign when it goes down, at least in large numbers. So there's a lot of new ways to invest, and speculation in the stock market became a big way to invest your money. And it was just this quick profit, this quick way to make a lot of money. And buying on the margin was how people did this. People purchased stocks to get a loan, and got a loan to purchase stocks. Now, this would really be very similar to getting out a loan in order to go gamble in Atlantic City or Las Vegas. You might win, you might lose, but if you lose, you're going to owe the bank a lot of money. We'll go into a little bit more detail on this in class, but they're creating fake money, and stocks are rising, but artificially. There's too many people in the market. And there's a famous story where Joe Kennedy was getting his shoes shined. This is the father of John F. Kennedy. And the guy shining his shoes was talking about how he was in the stock market. And that was a big red flag for Joe Kennedy, who realized the shoe shine guy, if he's in the stock market, something's wrong. This is not what the stock market is intended for. It's not supposed to be just any Joe Schmo puts money in. It's supposed to be people that have the money to invest, not people that are just investing to invest. So there's, some people realize that there was this thing. And then came Black Tuesday. And on October 24th, stocks fall and panic investors begin to sell off. It's almost like a disease. When there's a lot of selling going on, suddenly everybody feels like they should sell. And then 5 days later, on October 29th, the market crashes. The highs of the stock market are almost completely eradicated. Almost all stocks are gone. Businesses crumble overnight. People's fortunes disappear. People that had millions of dollars now had zero. They had nothing. And now, they have to figure out what to do from there. Some did not handle it well. There were people that jumped out of buildings, jumped off the George Washington Bridge when they lost vast amounts of money. That was something that happened, and that's kind of the tragic part of it. Some people couldn't handle going home and telling their families that they were not going to have any more money. Here's a graph here of the stock market from 1920 to 1936, and I just want to point something out here. You can see right here in February of 1920, you can see where the stocks are, and then obviously you see this really massive uptick here. And then, the big drop there in, later on in 1929. But overall, the market typically looks like this. Usually don't see the big ups and downs in this section. But when you look at the market overall, so if you look at where it was in February of 1920 versus where it is in, almost 1937, you can see that it's gone up. It's gone from 100 to almost 150. And typically with the stock market long term, that's what it will do. But they will have these big ups and downs from time to time that occur. So what did this mean? Well, the crash isn't the only thing that causes the depression. It's a part of it, but it's not the only thing. A lot of people think that the depression is created by the stock market crashing, but it was more than that. The economy was already weak. And the crash was an indicator that the economy had a lot of problems, that there was a lot of weakness in the economy. So we will talk in class about some of the different aspects of stock and look at some of the different stories related to this.